Markets have had a strong run year to date. U.S. stocks hitting record highs. The TSX up about 20%. Now, much of that because of the strong outlook for corporate earnings. But we're not without some headwinds. Both the Fed and the Bank of Canada cutting rates last week as they look to address weakness in their labor markets. So, how should investors be thinking about all of this? Justin Flowerday, Managing Director and Head of Public Equities at TD Asset Management, joins us. Justin, great to have you back on the show.
Good to be here, Greg.
Interesting times. We've got the BOC, the Fed cutting rates. I think the question becomes, are we on a sustainable path to lower inflation and strong growth?
Potent combo, low inflation, strong growth. I think you're heading in the right direction. I might change the adjectives a little bit and maybe instead of low and strong, go with steady and steady. But there's no question the cuts last week are an acknowledgement that inflation is getting under control, and we no longer really have to worry about the runaway inflation scenario. And look, both the Federal Reserve and Bank of Canada are now focused on growth and where is growth headed. And I think they're seeing some indications that are a little bit concerning, and they're now able to act. And if you look at the Fed and what they're looking at, they're concerned about tariffs and the impact it's having on supply chains in the U.S. and the manufacturing sector in the U.S. They're seeing pockets of weakness in the consumer, certain segments of the consumer, and they're trying to, essentially get ahead of any real demand weakness that could arise in the consumer. And they're looking at labor markets, and they're seeing continued pressure on some of the labor markets, and so they've decided to act. And again, I think it's an acknowledgement of the demand picture, which is changing, and the fact that inflation has come down.
When you take a look at a 1 year of whether it's the TSX Composite Index, the S&P 500, we all lived through the big downdraft in April. That was about the tariff regime. We seem to have moved past it and found a way to sort of reconcile, trading relationships. Are we out of the woods on that right now? The market seems to be trading as if we're not really worried about trade and tariffs.
Yeah, and all I would say is that there's going to be more headlines, and I would say the tariffs remain a very much a live macro risk that the markets are going to have to deal with. We'll get headlines in the coming 3, 6, 9 months on a couple different fronts. Number one is IEEPA. There's obviously a court case which is going to the Supreme Court in November, and we'll probably get a ruling in the first half of next year around how the U.S. can proceed in terms of the IEEPA tariffs, right? This isn't the Section 232 or Section 301 tariffs, just IEEPA. And then, of course, in Canada, closer to home, we're looking at USMCA and the renegotiating there. And we'll see how that plays out. But again, we're going to get a whole bunch of headlines, and with those headlines will come volatility. And we saw what happened earlier in March and April and how the market reacted to all that uncertainty. I'm not necessarily predicting a 20% type of sell-off or gain in that level of volatility. The market has kind of gotten used to understanding what tariffs mean and the impacts they could have, but some level of volatility on headlines should be expected. I mean, for portfolio managers on my team, I would just say that can be often an opportunity and something that we just need to stay on top of.
When I think about the tariff regime and the trade and the Trump administration trying to reshape global trade, there's been a lot of discussion this year about that will spell the end of U.S. exceptionalism. The U.S. markets over the last several years, you just sat back and watched them go higher and higher and higher. Sure. I mean, it's happening right now. We're sitting back, we're watching them go higher and higher and higher. Is the case still there?
Yeah, U.S. exceptionalism is not over. These are structural advantages that have been in place for decades, right? When you think about all the things that go into allowing them to grow earnings faster than other countries. And it comes down to a bunch of stuff. Labor flexibility is one thing, and you've seen a whole bunch of people move from California to Texas because they can, because there's that kind of mobility there, when you saw companies starting to move headquarters from California to Texas. So this labor mobility is a big factor. You obviously have a massive wave of innovation and productivity that's taking place across the U.S. That's being fueled by a capital markets kind of sector of the economy, which is deeper than anywhere else in the world. And of course, a venture capital ecosystem, which is deeper than anywhere else in the world. And so you have this kind of these forces which allow U.S. earnings to grow faster than other countries.
part of that story, it's got to be artificial intelligence. People have worried that with the run-up we saw at NVIDIA, some of the chip makers, you're waiting for the next step in terms of how does the productivity flow through to other names. Where are we in the AI boom right now?
Yeah, so look, the AI boom is in its early innings when you think about big picture, and I do believe that we're going to continue to see waves of beneficiaries over time, right? So we had the initial companies which benefited and have benefited from artificial intelligence, and they're mostly in the technology sector. A lot of semiconductor companies have benefited from this, and we've seen lots of headlines around NVIDIA and Broadcom and that play. I think what we need to pay attention to is the next waves of beneficiaries, right? And so, look, I think you need to look outside of the technology sector. And there's going to be a whole bunch of companies in the services sector. When you think about services, this is the insurance industry. This can be the healthcare industry. This is a big portion of the economy and companies out there who are going to use AI to become more efficient. And so we're looking at these companies and who's able to embrace artificial intelligence to become more efficient, to create new products. And I think when we look out 5 to 10 years, it's going to be that group of companies that we're going to say, oh, wow, they really have been able to improve their margin structure and are going to allow them to grow earnings faster than their peers.
All right, we put the market run to record highs together with some of these themes you're talking about, central banks getting back on the cutting path, and investors have the question, got a couple of months left in the year, can we move higher from here? Is it feasible for the markets to move higher from here?
Yeah, so it absolutely is. We are going to start to see different catalysts for the market related to deregulation, and we've started to see some more M&A and more IPOs take place because of that. We're going to see typically a stronger seasonal period in October, November, December. We're also going to start to hear from companies on earnings growth and expectations for next year. And I think that there are a lot of companies who are going to provide a pretty optimistic view of, again, where their cost structure is going and some of the revenue opportunities they're seeing. And so, look, we're still optimistic. I don't think the next leg up comes from valuation expansion, but I do think earnings can grow healthily from here.